Welcome to the Economy Magazine. I'm Benjamin Chong Alfares, and today we break our general routine with a macro review of the world markets. World economies continue to be shaken by events and policy decisions related to the Great Recession, geopolitical conflict, and the oil price drop. Tal Keinan, founder and CEO of investment management firm Clarity Capital, joins us for a clearer understanding of the risks and opportunities underlying these tumultuous times. Mr. Keinan, thanks for joining us.
Thanks for having me.
So, all eyes are on the U.S., essentially the strongest market, taking a very central role in the world economy today. Everybody's looking at U.S. data coming out for hints at what the Federal Reserve might do next.
Right.
Where does the strength from the U.S. economy stem from?
Right. So I'm glad you used the word strength. I think that's how I would describe it as well, certainly in relative terms. And the key answer to your question is the U.S. consumer. And in most ways, the U.S. consumer is back. And just to understand, in a global economy that's, on the order of $70 trillion global GDP, the United States is over 17 trillion of that.
Right.
That's about a quarter of total GDP is the United States. 70% of U.S. GDP is consumer spending, more than 70%. So, close to 20% of global GDP is the U.S. consumer. The U.S. consumer is back. That is a big part of the reason that we're seeing kind of economic growth in many places, not just in the United States.
Right. And we're talking obviously about jobs and jobs figures. I believe we have a comment from Janet Yellen, the Federal Reserve Chair, regarding job figures, which are also, by the way, coming out tomorrow. So we'll have a better understanding of where we're going with the Federal Reserve.
Slack in the labor market continues to diminish. Meanwhile, the labor force participation rate, the percentage of working-age Americans either working or seeking work, is lower than most estimates of its trend, and wage growth remains sluggish, suggesting that some cyclical weakness persists. Looking ahead, however, the committee continues to expect a moderate pace of GDP growth, with robust job gains and lower energy prices supporting household spending.
Now, clearly, Janet Yellen says that the growth figures are largely stemming from, as you said yourself, stronger consumers, essentially, good job figures. Where do you see this improving growth outlook going, and how will this affect the interest rates?
Right. Well, a consensus is that this summer interest rates should start rising in the United States. And you have to remember, we're kind of on a continuum. So we had quantitative easing, essentially the Fed printing money and kind of inflating the monetary system in the United States. That tapered. The tapering is over. So we're on a continuum now of monetary tightening. I wouldn't say this is necessarily a quantum event, the fact that interest rates are finally going to start rising.
Would you say this is good or bad news for the markets?
I would say it's inevitable news, right? I mean, interest rates can't stay at zero forever. So in general, the fact that we're kind of coming back into a more normalized world, and we're just talking about the United States at this point, is probably good news on balance. We need to get there at some point. Again, it hasn't happened yet. Let's see what happened, as Yellen commented in her remarks.
It's been a balancing act. It's been very interesting to see, say patient, don't say patient. They constantly, they play on words, and people are jumping basically at every single change, minor, tweak of the policy. It's incredible, really. What can we truly expect from the Federal Reserve when it comes to borrowing costs? Will they go, as you said yourself, this summer they will go for a rate hike? Right?
I don't know. That's definitely consensus. The consensus view is that that will happen. There are other remarks from Janet Yellen and some from Stanley Fischer last week, that are kind of remain ambiguous. You remember, central banker's job is very much a communications job. Exactly.
Now, the interest rates going up, what does that mean for the equity market? Or what has it meant for the equity market that it has been so low?
Right. Well, let's zoom out a little bit on that. And I think one of the things you've seen this year is real outperformance of European equities over U.S. equities. And I think one of the underlying factors has been exactly what you're alluding to, which is that the United States is at the beginning of a tightening cycle, the early stages of a tightening cycle. The Europeans are just entering an easing cycle, so just started quantitative easing. Right. So we're going to see a lot more liquidity in Europe and a lot more impetus for equities to rise.
I'm happy you mentioned Europe, actually, because I actually wanted to turn away from the North American market and shift over to Europe, which is also very interesting. Obviously, it's a big story developing as we see it. What kind of overseas growth opportunities do you see in Europe?
Right. So, opportunities for an investor. Let me address in a second. In terms of growth, let's be clear. I expect seriously lackluster growth in Europe for a long period. If the U.S. is growing at above 3%, in 2015, probably above 3% again in 2016. We're not seeing that in Europe. Europe is going to be, kind of a 1 to 2 type percent growth. That said, again, we have this easing policy going into effect. Mm-hmm. We have cheap oil, which is a huge tailwind to the European economy, much more than to the U.S. economy, which is much closer to kind of energy independence than Europe. Yeah.
One of the biggest issues for Europe has been this gap, right, between Germany on the one hand, France, the second biggest economy, not doing so well, and of course you have the pigs, and specifically Greece. Right. Now, Greece is kind of a wild card there, isn't it? I mean, what kind of part does that play?
So, so interesting. The fact that we've seen this really, I think it's above 17% at this point, rally this year so far in European equities speaks to certainly renewed kind of confidence in European equity markets, obviously. We've seen in the top 8 Eurozone economies, we've seen GDP growth for the first time since the crisis. So that's a big deal. Greece is what I think a lot of people point to when they say, all right, we see uncertainty looking ahead in Europe. And listen, I don't want to play this too lightly, and certainly that's the notion of a Greek departure from the euro is a possibility.
So Grexident,
yeah.
Which would be a good thing for Europe?
So, okay, exactly. I'm not sure that's a bad thing necessarily.
Mm-hmm.
What you have at the end of the day in Europe, this is, if you go back and read Jean Monnet from the 1950s on the creation of this whole project of a unified Europe, this was going to happen in stages, and it's not going to work smoothly all the time. And so the idea of split fiscal policies but one monetary policy does not work. Europe is structurally different, and maybe Greece and Germany do not belong under the same monetary umbrella.
Right. And speaking of which, the ECB, what can we expect from them in this regard?
So in regard to, the ECB has to play a very interesting political balancing act that the Fed is really free from at the end of the day. Meaning we have to, balance inflation on the northern side of the continent with still serious recession. I would even call it depression in the southern part. Because the ECB is not really a political body, I wouldn't see any impetus from the bank for secession or anything like that. I don't think that's,
Yeah, clearly Europe is a very mixed bag there. So let's move on from this to Japan, where the Abe reforms don't seem to really have, such a great impact yet. The country is still essentially moving along very slowly. It still hasn't broken out of the cycle. Sure. It's not entirely clear where it's going, but, what does it mean for investors?
Well, look, so let's remember the context is we've had 2 decades of utter stagnation in the Japanese economy. So I would say any growth at the end of the day is good news.
Good yeah.
So I agree with you. We've been disappointed. I think we were looking at something like 3.5% to 4% growth in Japan, and we've kind of had to make do with 2 point something. Okay. It's still early in the process. There's on the monetary side where we've seen most of the movement. There's obviously still ammunition. There's also fiscal ammunition to be had in Japan. The effect of a weaker yen, which quantitative easing in Japan has produced, it may take a while for us to see the full impact of that, but I expect it'll be strong. It'll help, earnings for, Japanese exporters at the end of the day and Japanese equity prices.
Yet at the same time, I mean, the weaker yen on the one hand is a boon. On the other hand, it has also made it harder for Japanese manufacturers to buy the materials that they need.
True. That's true.
And also driven up prices.
That's true.
I mean, it's sort of a mixed bag again.
It's a mixed
right?
bag, although it nets out as a plus. Because remember, you're kind of cooking margin into your finished product. So, if you're importing iron ore, you're adding a lot of value to that in Japan before exporting it. So net, I think it's a good thing for Japan. It's a good thing for Japanese equities, up 14% last year. It's nothing to sneeze at.
Yet at the same time, we do see another potential contraction when it comes to the growth in Japan in February, about 2.1%, if I'm not mistaken.
Right. That's right. So, yeah, true. Disappointing. Again, if you're looking at 4 as a benchmark for sure, but if you look at the last 20 years, maybe not. And I would say probably still too early to judge.
Now, Shinzo Abe won, not miraculously because he didn't have much opposition there, but what... Abenomics has been given so much, everybody believes in it being the magic pill, so to speak, that Japan will take, and everything will be magically, suddenly changed around. Will he really be able to turn around the situation there? What are the indicators?
Look, so there is no magic, clearly. I would say that in a period of competitive devaluation, which might be a slightly cynical way to look at what quantitative easing has been around the world, but I would take that view. The Japanese are really just getting into the game now. The Americans were the first and the strongest, and they did it. Again, they took their kind of lumps up front, and are really the first to be on the path to recovery from this recession. The Japanese are just starting right now. Abenomics should not be judged at this point. Let's see. Let's let this thing play out, and I would give it a couple of years.
I see. Yeah. Well, let's move on now from there to the emerging markets.
Right.
Most specifically, if you look at the U.S., you look at the EU, look at Japan, leading the way. What can be said about the emerging markets? Where do we see the emerging markets fitting in this picture?
Right, so we've seen a really interesting roller coaster in emerging markets, and a lot of kind of changing assumptions. I remember the Goldman Sachs term BRICS,
of course.
Brazil, Russia, India, China, which today I think there's very little case to be talking about those.
You didn't
economies.
even mention South Africa for that matter, which is interesting considering that they just got bumped to second place in Africa, Nigeria taking over. No, it's interesting. It's true. It's true.
But there's little case to be made for looking at those economies as any kind of correlated entity anymore.
No,
That's
each
just
one
not
has
the
their
case.
crisis. I mean, you have Brazil currently dealing with Petrobras, Dilma Rousseff trying very hard to change everything around that she did for the past 4 years. You have Russia in serious mayhem with, of course, the ruble falling based on the oil prices. I mean, India.
Okay, India is interesting. So I'm glad you laid it out like that. And I think that's a very good way to look at it. The term emerging markets today can be quite misleading. For the last 2 years, I'd say for the first of the last 2 years at least, and maybe the entire last 2 years, there was a case to be made for emerging markets being weak in general, basically due to kind of global consumption slowdown. That's happened. India, in our view, is really kind of a beacon of light right now in emerging markets. You look at Modi's business-friendly policies, serious structural reform that's happening today in India.
Very serious plans to cut back energy imports by 10%, if I'm not mistaken, by 2022.
Yeah.
And actually boost the local production of energy. I mean, is it a little too ambitious?
Well, look, whether it is or not, we're already.
At least he's doing it. He's moving towards that point.
But also look at India's total energy bill. With oil at $50 to $55 versus $100 plus.
Yeah.
India is in a much different position as an energy importer. And by the way, that has allowed a kind of virtuous cycle to evolve, where India can take a much more dovish monetary policy stance because inflation is really curtailed, and I think energy costs is part of that having happened in India. So we can expect interest rates, to stay down. And I think that until very recently, the fear was that India would have to hike. That's not happening. Making Indian bonds, first of all, an interesting investment, but also kind of perpetuating this virtuous cycle that you're talking about. So we're quite bullish on India. And even if you look at the bigger picture, in terms of working age population, Indian demographics look better than Chinese demographics at the moment. So, we could be entering a phase where India becomes a much more dominant player.
Better than Chinese demographics? Elaborate a little bit.
Well, the Chinese labor force is shrinking. We went through a long period with a very low birth rate in China. India, we're seeing the opposite. India's growing, and right now the biggest middle class in the world.
Interesting indeed. Well, on that very note, essentially China, we're not going to really talk about here because it's a very different kind of market, of course, has been seeing a lot of slowdown. India, last comment as we go out, good for investors?
India? Yeah, so Indian equities already have been. I would say, again, without giving any investment advice, it's worth having a good look at Indian government bonds.
Well, Tal Keinan, CEO and founder of Calera Capital, thanks for joining us on the show. That is the end of our special with Tal Keinan. Again, thank you very much for watching. We'll be again on this same channel next week with more on the economy.